Back with closing trades right here in ET now. After that breach of sub 17K, we're finally seeing a bit of a recovery coming in, but I would say it's a little bit feeble because we're unable to hold on to that 17,100 print. So let's see which way we actually head. We have a little less than half an hour still to go for trade, and frankly, anything can happen in the next 25 minutes. Gurmeet Chadha as well joins in on the show right now. Gurmeet, hi, afternoon. What do you do in this panic, Gurmeet? Just wait for the desk to settle down and sit on the sidelines?
Maybe partially, yes. Considering the environment. So three times I've seen market in green today, and within half an hour, it's gone down by 100 points on the Nifty. I think also the situation warrants that if you see by take past experience. So what Fed is saying is that, or the joint statement says that they're protecting depositors, but they're not protecting investors, right? Equity and bondholders, which means that there is a rush to sell, and that's the reason you're seeing the bank indices in US and Europe correcting much more than the broader markets. Yesterday also we saw a huge run on some of the smaller banks, down 60-70%. So in a situation like this, it takes time for things to stabilize, and I think the market will also take time to figure out whether this is more systemic or just confined to a concentrated set of investors. And then there are second order impacts in terms of on the IT companies, bigger impact on startups, a slightly lesser impact on IT companies who were, let's say, dependent on some of these banks, and BFSI is a significant portion. So I think things should get stable. It doesn't look still now a systemic risk to me. I think some accident was probably waiting to happen with the way rates were being raised, and I think the dust should settle soon.
Right. Gurmeet, how do you approach this market? Just look at companies which are tried and tested, where you have, trust on numbers versus others where you believe it's a hope trade.
Yeah, so so two kinds of approaches. So because we manage client money, so one side, clients who are conservative, we don't do much. We stay on the sidelines, and sometimes, as I said, not doing anything is the best thing to do. And for clients who are a little more aggressive and are willing to take some volatility, we are looking at pockets where. So, for example, I think Indian banking system is far more robust, and any correction, I think, is an opportunity. And this is not the time we have seen 10-20% decline. It has happened maybe last 20 years, probably 15 years, you would have more than 10% corrections, right, every year. So it's not for the first time, won't be for the last time. So we are looking at some solid banks where I think the provisioning is strong. Credit growth, if you see even February data, points to a 15% credit growth. Strong on liability. I've been saying this repeatedly, that liability side would be a differentiator this year. We are also looking at some good opportunities. I think there is a clear capex revival at play. So we are looking at this housing-led capex. Also looking at some of the names in industrials and capital goods. I think cement looks very good to me, because not only there is a housing demand. There's a huge focus on infrastructure, the way the budget has come. So these are some of the pockets we are trying to derive some value.
Interesting. Gurmeet, stay with us, and thank you for those ideas for those of our investors who are willing to buy and have some amount of risk appetite. But the global jitters clearly have managed to grip the street. We have been speaking with a whole host of experts, from Samir Arora to Manish Tangi to Nilesh Shah and Mithul Katecha. Let's hear out what their opinion has been on the recent fall in the markets.
Broadly over time, equities will do well, and secondly, that broadly over time, if you buy on fear which is not directly associated with you, you will mostly do better than other markets where their fear might be more valid up to a point. But I don't see the connection between US banking sector and our banks at the first level. Like, the market is down less than 0.9%. If you look at it year to date, the market is down like 4-5%. And this is after absorbing a very big issue, which at the end has been handled well, which is from their point of view, the Adani issue.
Very unlikely that anytime soon we are going to ZIRP, which is zero interest rate policy in US. It's very unlikely that RBI would actually come with dollops of liquidity anytime soon. And which is why, the tightness in the markets would sort of sustain very likely, even though inflation's sort of peak, as you said and alluded to, is very much behind us. It's just that the scare of it, of its return is so much that central bankers, Nikunj, would rather be circumspect, for throughout 2023 and not cut rates, or, perhaps, we'll pause on QT, but we'll certainly not do QE. And all of that doesn't augur well for equity, Nikunjan, which is why, I'm afraid that even today is meant, but I continue to say that stay out, be underweight, general equity, and be extremely cautious of small and mid cap.
In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India.
It has implications for policy going forward. As Andrew just mentioned, obviously, we've seen a significant rally in US bonds. Markets have pared back, tightening expectations to the point where now there's only a 1 in 2 chance of priced in for a Fed hike at the next FOMC meeting. And again, it seems like an overdone reaction, but now there's a real chance that the Fed will pause. So I think amidst all this volatility, the Fed is also trying to gauge the market reaction. We've had substantial weakness in European equities. Today, we've had, or will be seeing that in the futures. We've had we've had some weakness in US markets, but not significant. Bank stocks certainly came under a lot of pressure.
Gurmeet, the other thing that one is witnessing in the market, I mean, the fact that, yes, equities are the ones which are crashing, but both gold, Bitcoin are actually moving up while yields are seeing a significant amount of drop. What is it that you're making of this, move or gush to Bitcoin on one hand and gold as well?
I won't comment on crypto. Never invested, don't intend to. I think gold is usually a beneficiary. Whenever there is volatility, there is some flight to safe haven. But if you normalize it over a period of time, so maybe for hedging purpose, a small allocation can always go there. Let's say if this crisis escalates, probability is low, but if it does today, Credit Suisse, the swaps have gone up by another 40-50 basis points to almost 525 basis points. So if let's say it spreads, let's say for which a very small probability, and that time probably safe haven does well. So a small allocation to gold as a hedge may work. Anyways, Indians have a lot of gold otherwise also, in terms of if you count the physical gold we have. So I'm not a great fan. I think bonds, in my view, I think because we are nearing, I think the peak rates of inflation in my view have passed. I think you will see a pause from all central banks. It could be very early. It could be, let's say, in a month or so. So I think maybe going on bonds, considering that in India probably the real yield is still positive by 1% plus, with inflation at 6.4 and let's say the 10-year bond at 7.4. I think there is still some scope there. I think maybe one can add more bonds to the portfolio for the time being, get a good carry and possible some mark-to-market gain as yields ease off. For investors with slightly conservative approach.
Right. Okay. Those are a couple of ideas coming your way in terms of which way investments are actually moving. Adani Enterprises also actually is seeing a bit of a recovery coming in. That stock was down, I think, in double digits at the lows of the day. It's recovered a fair amount of ground, but autos is not really seeing any recovery. M&M is still down about 2.5%. IT as well, TCS, TechM, HCL Technologies, Wipro, they're still down. There's Tata Motors also, which continues to languish. Kunal, let's first get a word in on IT. The fact that the index has fallen when it was already underperforming, has the time come now to buy IT?
Well, I would say the index was not underperforming in the last 1 or 2 months. In fact, it was more resilient, because if you look at the banking stocks, you look at the auto names, these stocks had actually started to get into a correction much earlier. It's only Infosys out of the large cap IT stocks which was correcting, but TCS, Tech Mahindra, Wipro I think we can exclude because the stock has been an exception both on the upside as well as on the downside. But most of the large cap and the mid cap IT stocks, they were actually performing pretty well. end of 2022 and the first 2 months of 2023. So my sense is that the large cap should stabilize first. I would still believe that TCS as well as Infosys, they could be very good buys for someone who has a medium to long term time frame. And then once the sector starts to get into a trending mode is where you can add on to mid cap stocks from the IT pack.
Right. Okay. Interesting. Naresh, let's also get in a word on, autos, like Kunal just mentioned, as to how the move has been and the selling first began in the auto names. And I can see one of the best performers, M&M, for instance, cracked quite a fair bit. What do you do here?
So Mahindra and Mahindra has given the first indication of, say, breakdown. So if you look at the 1200, 1230 mark was sacrosanct across the corrections over the last 6 months. And now finally we've broken that. So that indicates that the momentum is finally gone and it could retest lower levels before making the next move. So I would expect, say, closer to 1050 to 1080 is where I would like to buy. If that doesn't come, would wait for a recovery back about 1250. That would indicate it's a false move on the downside. But yes, the momentum has been finally broken. The stock now needs to go back about 1250 to make it interesting, or at 1050 it becomes a buy. The longer term structure, if you look at the multi-year breakout which has happened, is still pretty much in place. So 1050 to 1080 is where I would like to buy the stock.
That's the take coming in on M&M right now. Shortly, we're going to be chatting with DP Singh as well from SBI Mutual Fund, and we'll cut across to that conversation. Would be interesting to hear out the mutual fund side of the story and as to whether or not there is any amount of panic which mutual funds see that may set in after the selling in the markets of late. We will cut to that in just a short while from now. Just scouting for some other names as well, in the market. And the breadth of the market, by the way, has recovered quite smartly. And I'm just looking at the, F&O picture. It's 103 account to the reds with 91 to the greens. I mean, to think of it, for a breach of 17,000 as well earlier today, this breadth to close the day with is really not that bad at all. Bandhan Bank, though, is still down. Intellect Design is still down. ABFRL is sharply lower. It's down 4%. And Ambuja as well, lower by about 4%. But look what's happening on the GMR Infra, for instance. PVR is holding up 2.5%. Z is seeing quite a bit of price action, holding up 2.25%. United Spirits looking smart by about 2.25% again. And M&M Finance as well is also the one holding out quite smartly as we speak. Gurmeet, where in this market would you want to be contra in, if at all?
I think IT. I think and bit of pharma and specialty chemicals. I think really beaten down. Sometimes when there is the headlines are very negative, is when you get some real good bargains. Look at some of the chemical companies like Tata Chemical at 12-13 times earnings. Largest.
Apologies, Gurmeet, to just stop you there. I'm going to quickly